I will be taking up Unit 6 of the subject Stock Market Operations. In this unit, we will be studying 3 sections. The first is how to build wealth with exchange traded funds. Second, building wealth with mutual funds. Third, taxation of shares, mutual funds, ETFs, and future and options. So moving forward, how to build wealth with exchange traded funds. ETFs are versatile securities that each gives access to a breadth of stocks and other investments such as broad index or industry subsector. Because ETFs often represent an index of an asset class or subclass, they can be used to build efficient passive indexed portfolios. ETFs are also used relatively inexpensive. They offer higher liquidity and transparency than some mutual funds and trade throughout the day like a stock. Benefits of ETF portfolio. ETFs are baskets of individual securities, each like mutual funds, but with the 2 key differences. First, ETFs can be freely traded like stocks, while mutual fund transactions don't occur until the market closes. Second, expense ratio tends to be lower than those of mutual funds because many ETFs are passively managed vehicles tied to an underlying index or market sector. Mutual funds, on the other hand, are more often actively managed. Because actively managed funds don't commonly beat the performance of indexes, ETFs arguably make a better alternative to actively managed higher cost mutual funds. Creating an all ETF portfolio. Sector ETFs. It concentrates on specific fields such as financials or healthcare. Choose ETFs from different sectors that are largely uncorrelated. For example, choosing a biotech ETF and a medical device ETF would not be a real diversification. The decision about which sector ETFs to include should be based on fundamentals, valuation of the sector, technicals, and the economic outlook. International ETFs. These cover all regions from emerging markets to developed markets. International ETFs may track an index that invests in a single country, that is China, or an entire region, that is Latin America. Similar to sector ETFs, the choice should be based on fundamentals and technicals. Be sure to look at the makeup of each ETF as far as individual stocks and sector allocation. Commodity ETF. These are an important part of investors' portfolio. Everything from gold to cotton to corn can be tracked with ETFs or their cousins, exchange traded notes. Investors who believe they are savvy enough can choose ETFs that track individual commodities. However, individual commodities can be extremely volatile, so a broad commodity ETF may be better suited to your risk tolerance. The second section covers building wealth with mutual funds. A mutual fund is an investment tool where a pool of investors come together with small savings and give it to a company with a panel of professional expert investors who invest the money in a variety of securities on their behalf. How to invest in mutual funds? There are 2 ways in which one can invest in mutual funds. Monthly installment. In this type of investment, you make regular payments towards the mutual fund investment, popularly known as systematic investment plan. This is ideal for small savers and those who don't want to invest all once. You can invest as little as 500 rupees per month. This amount differs from bank to bank. Lump sum. In this method, there is a one-time annual payment. Instead of investing every month, you can make a whole payment at the start of the tenure. There are various types of mutual funds based on the types of securities in which money is invested, such as debt mutual funds. Here, money is invested in a variety of debt instruments. Then there is equity mutual funds. Here, money is invested in equity only. Hybrid mutual funds. Here, money is invested in mix of both debt and equity. Solution-oriented mutual funds. Here, money is invested for a purpose such as one's retirement plan or a child's education. Duration of investment in mutual funds. Except for ELSS, Equity-Linked Security Scheme, which provides tax benefit and has a lock-in period of 3 years, mutual funds do not have mandatory lock-in period. You can withdraw even after 1 day, but this is subject to a penalty called exit load. Even though you can withdraw by selling your units anytime, most mutual funds come with a fixed duration, which could be 1, 3, 5 years or more. To discourage frequent withdrawals, as earnings are maximized only when invested for a longer duration. Benefits of mutual funds. There are many benefits of mutual funds as an investment tool, such as expert advice. Investments in mutual funds are made by professional experts who are also seasoned investors and know how to pick the best securities that generate high returns. Mutual funds are known to generate high returns since there is no cap on earnings. Depending on the performance of the security where the money is invested, returns are generated. Since financial experts invest money on your behalf, returns are generally high. Small investment. A person can invest small savings every month in mutual funds and still earn high returns. Unlike other securities, where an amount has to be invested all at once and locked in for a certain period, mutual funds let you invest small savings every month. The last part of this unit is taxation. Taxation of shares, mutual funds, ETFs and future options. The primary goal for investing in any asset is to generate a profit by selling it after its value appreciates. But these profits are not always tax-free. The income tax specifies the various capital assets that are taxable as well as the tax rates that apply to them. As per the Income Tax Act, any profit earned from capital assets such as stocks, mutual funds, gold, real estate, etc. is termed as capital gain. These capital gains are subject to tax depending upon the type of investment. Taxation for equity shares. So, students, as we know what are equity shares, there are different criteria for taxation on equity shares. Here in this table, there are two types of equity shares mentioned. The first is listed domestic shares and the second is unlisted domestic shares. The holding period for both is different. For listed, it is up to 12 months or more than 12 months, and for unlisted, it is up to 24 months or more than 24 months. For up to 12 months, for listed domestic shares, the short-term capital gain rate is 15%. And for more than 12 months, long-term capital gain is 10%, exceeding 1 lakh in a financial year. In unlisted domestic shares, it is as per the income tax slab rate of the investor for STCG and for LTCG, 20% with the indexation is considered. Capital gains taxation rules for mutual funds. Mutual funds can invest in various asset classes such as equities, debt, or a combination of different asset classes. Based on the type of investment, mutual funds can be classified as equity mutual fund, debt mutual fund, or hybrid mutual fund. The taxation rules for mutual fund differ based on the underlying investments. Equity mutual funds. For equity mutual funds, short-term capital gain at 15% applies to capital gains from equity mutual fund units held for 12 months or less. For a holding period exceeding 12 months, capital gains from an equity mutual fund are treated as LTCG. The LTCG rate in this case is 10% of cumulative capital gains over Rs 1 lakh for a financial year. Debt mutual fund. In the case of debt mutual fund, capital gains from units held for 3 years or less are subject to short-term capital gains. So long-term capital gains in debt funds apply to units held for more than 3 years before being redeemed at profit. Hybrid funds. Hybrid funds have equity allocation of either less than 65% or more than 65%. So determining whether equity or debt taxation rules are applicable is quite simple. Here is the table given for that. In aggressive hybrid fund, 65 to 80% equity and the remaining asset classes 20 to 35. Similarly, for balanced hybrid fund, 40 to 60 in equity and 40 to 60 in other asset classes. For conservative, there is less percentage tied for equity, which is 10 to 25, and the remaining for the other asset classes. For multi-asset allocation fund, 10 to 100% for equity and the remaining for other asset classes. For equity saving fund, 65 to 100 and remaining for the other asset classes. For arbitrage fund, 65 to 100 similar to equity saving fund and the remaining for other asset classes. For dynamic asset allocation, the percentage can vary for both equity and other asset classes. Taxation rules for exchange traded funds. Exchange traded funds or ETFs are similar to mutual funds as they have pooled investment but can be traded on stock exchanges like equity shares. There are currently 4 types of ETFs: index ETFs, sectoral ETFs, gold ETFs, and international ETFs. Exchange traded funds or ETFs are similar to mutual funds as they have pooled investment but can be traded on stock exchange like equity shares. The first we'll discuss is index ETFs. The index ETF track the movement of indices such as Sensex or Nifty, whereas sectoral ETF track sector-specific indices such as Bank Nifty. For taxation purpose, index and sectoral ETFs are treated the same as equity-oriented investments. So for holding periods exceeding 12 months, LTCG of 10% is applicable on aggregate gains exceeding Rs 1 lakh in a financial year, whereas STCG tax at 15% is applicable for a holding period shorter than 12 months. Gold ETFs and international ETFs are taxed similar to debt mutual funds. So if the holding period is less than 36 months, STCG is as per the income tax slab rate of the investor. But if the holding period exceeds 36 months, the LTCG tax at 20% with indexation is applicable. Taxation rules for fixed income investments. Fixed income investments such as bonds can be either listed or unlisted, which impacts the rules governing the taxation of the investment. Example of the listed debt instrument are debentures, government securities, corporate bonds, tax-free bonds, etc. In the case of listed debt instruments, LTCG is applicable if the holding period exceeds 12 months, while STCG is applicable if the holding period is less than 12 months. The STCG rate for these investments is according to the income tax slab rate of the investor. The LTCG rate is either 20% with indexation or 10% without indexation. But as per current taxation rule, the indexation benefit is only applicable to a few listed debt instruments such as sovereign gold bonds issued by the RBI and capital index bonds issued by the Government of India. The below table summarizes the holding period, type of capital gain, and tax rate applicable to a listed and unlisted debt investments. For listed instruments under debt less than 12 months, it is called short term, and the rate is lower among 20% with indexation and 10% without indexation. Similarly, for unlisted instruments, the time period is 36 months less or more, and the rate is 20% without indexation. Taxation rules for gold investments. From the perspective of taxation, 4 of these gold investments in India are physical gold, digital gold, gold ETFs, and gold mutual funds. All of these investments qualify as LTCG if the holding period exceeds 36 months. The STCG tax rate for holding periods shorter than 36 months is as per the income tax slab rate of the investor. LTCG rate is 20% with indexation. The tax rules are a bit different for sovereign gold bonds. In this case, all capital gains are tax-free when the bond matures. But if an investor exits this investment before maturity, then the same STCG and LTCG tax rules are applicable as other types of gold investments. Taxation rules for real estate investments. Immovable property such as real estate is subject to its own unique set of capital gains taxation rule. In the case of these investments, STCG tax rules are applicable for a holding period shorter than 24 months, whereas LTCG rules apply if the holding period exceeds 24 months. In the case of real estate investments, the STCG tax rate is according to the investor's income tax slab rate. The LTCG tax rate applicable to these investments is 20% with indexation. But the purchase and the sale of real estate also feature some additional types of tax rules and conditions. These regulations include 1% TDS on property sales exceeding Rs 50 lakh, mandatorily reporting sales exceeding 30 lakh to the Income Tax Department. In recent years, another type of real estate investment has gained significant popularity in India, which is Real Estate Investment Trust or REITs. At present, there are 2 types of REITs in India: listed REITs and REITs mutual fund. Investors can purchase listed REITs on the stock exchange, and a demat account is mandatory for this investment. Examples of listed REITs in India are Brookfield India, Mindspace Business Parks, Embassy Office REITs. In the case of these REITs, a holding period of more than 36 months is necessary to qualify for long-term capital gains. The STCG tax rate on REIT units held for less than 36 months is 15%. The LTCG tax rate for REIT investment is 10% on gains exceeding Rs 1 lakh. Investors can purchase REITs mutual funds such as International REITs Fund of Funds without a demat account. These investments are taxed as per the rules of the debt mutual fund. So STCG rate is according to the income tax slab rate of the investor if the holding period is 36 months. In contrast, the LTCG tax rate for this REIT mutual fund is 20% with indexation if the holding period is more than 36 months.